a seismic shift here.
Well, yeah, I mean, in previous days, before the crisis, you really thought of bonds being sold by banks going to investors and saying, look, you know, they'd have road shows, they'd sell the bonds, they'd say, look, you really should buy this, it's a great bond, and investors would choose whether or not to buy that. Well, since the crisis, there's been a food fight for almost every single corporate bond sale that's come to market. Basically, every single one, if you got in on the ground floor, you got really big outsized gains. There's actually been an entire industry being built around flipping. In other words, you get an allocation to a new sale, and you want to, if you sell it right away, usually you'll get a gain right from just being allowed to participate. So where does this leave the big investors? They want to get that allocation. They want to get in on the ground floor. In order to do that, you've got to be more aggressive. You can't just wait for the banks to come to you. You have to go to those companies that you like. You have to go to the syndicate desks of these banks, and you have to say, look, what's coming? We want this. We would buy this. And then they can get in on that allocation, and they can get more of what they want.
What does this tell you about overall broader changes in the Treasury market? I mean, it seems to me that it's symptomatic of more and more power going away from the banks and into the hands of the asset managers.
This is symptomatic, exactly as you say, of Wall Street shrinking, whether it's in response to regulatory changes, whether it's in response to just less of a risk appetite, frankly, after the credit crisis. But you are seeing banks shrink, and institutional investors are having to take some of these roles over if they want to have the same kind of debt that they have grown to appreciate. I mean, this stuff has gained a lot of returns over the past couple of years.
Okay, was this something that was going to happen naturally, or did these rules, these regulations about paring back risk actually force their hand?
Yeah, was the catalyst Dodd-Frank?
Yeah.
From the people who I talked to, this was definitely a part of it. I mean, this type of reverse inquiry has always been sort of done, you know, on very rare occasions previous to the credit crisis. Post-crisis, increasingly, investors that want bonds may not have even been able to find them, may not have even been able to go to the dealer and say, do you have, you know, X bond in your inventory? Can I buy that? Now they have to be much more aggressive. So, yes, I think that the people who I speak to do think it's an outshoot of some of the regulations.
Do you have any sense of the scale, what portion of corporate debt sales are now being initiated by the money managers going to the banks?
You know, I have heard estimates that range from a relatively small proportion to a majority. I think it sort of depends on how you define it. I know one money manager who sends a list around every month of bonds that he would like to see in the market to all of the syndicate desks. So, you know, it sort of depends on how you define reverse inquiry, or how you define this universe, right? Because I think a lot of people would like to say that they're doing it for almost every deal so they can get a better allocation.
And Lisa, just quickly, the impetus for this, BlackRock bringing in someone in, is that how this all started?
Well, BlackRock did form a capital markets group in 2010, and their idea was to sort of make more of a aggressive effort to have a role in underwriting some of these bonds and creating some of these bonds. And others have followed suit. I mean, you have seen in the past year, Babson create a capital markets group. Alliance Bernstein has committed somebody. Many other firms have sort of efforts devoted to contacting companies and being more into this kind of
You know, only
practice.
Lisa Abramowitz can make the business of underwriting bonds interesting. Thank you.
And make it make sense, because this is very
Hey, it's a
complicated.
$39 trillion market. It's important.
The U.S. bond market is
Yeah,
$39
US
trillion.
bond
This
market.
particular market is $8 trillion. It's a big market.
That is